All right, you're broadcasting.
Hello and welcome to the third session of Financial Statements series of web events at the Peterson Institute. We're a little bit ahead of schedule to start this broadcast, so I will wait a minute more before starting talking. Okay, let's start. My name is Nicolas Véron. It's my pleasure and honor to welcome our panelists and attendees to this session of the Financial Statement series at the Peterson Institute for International Economics. And today we have two guests to discuss the episode of market volatility in mid-March 2020, a couple of months ago at the beginning of the lockdown period in a number of countries. Our first guest speaker is Anil Kashyap, who is one, in my personal opinion, one of the very few academics out there who is able to reconcile a macro view of the economy and a very granular view of what's happening in the financial sector. So I'm very grateful to Anil for having accepted this invitation. Anil is probably known to a number of our attendees. He started at the very beginning at the Federal Research Board, but then got his PhD at MIT. I think his advisor was Olivier Blanchard, who is now at the Peterson Institute, and has been at the University of Chicago since 1991, of course, at the Booth School of Business. So a very long tenure on the borders of Lake Michigan, which we can see behind him. He's also been since 2016 for a first three-year term, which has now been renewed at the Financial Policy Committee of the Bank of England. And that's relevant to our discussion because the Bank of England had a report on the mid-March episode, what they call the Dash for Cash, which was circulated, the link to it was circulated to the invitation to this session and is on the Peterson Institute webpage. So I think Anil will talk about this report. The second speaker is Peter Fisher. Peter Fisher also, I think, well known in this community. He has started at the Federal Reserve Bank of New York, if I'm correct, between 1985 and 2001. With a short stand at the Bank for International Settlement in Basel in the late 80s. And then he was Undersecretary for Domestic Finance at the US Treasury in the early 2000s, then at BlackRock for more than a decade. And from 2013, the first head, I think, but you'll correct me, Peter, of the BlackRock Investment Institute. That's also the time when he joined the faculty at the Tuck School of Business at Dartmouth, where he is now and from which he's joining us. So enough from me. As you know, the theme is mid-March. I'm not going to expand on this because Anil will. So Anil, floor to you.
Hey, thank you, Nicolas. And it's a pleasure to be here with you and with my old friend, Peter Fisher. And I should say, even though this is related to the work at the Bank of England, I'm here in my personal capacity. So this is not an official FPC speech. So I'm going to talk about three things today, which is what happened during that brief period in March when financial markets became dislocated, an attempt to say a little bit about what that might have revealed, and then some questions really about the policy implications of all of this. So here's a picture on the left here that if you squint very, very hard, you could see this short period where you could see that treasury yields were rising at the same time stock prices were falling. And if you graph the VIX would have been spiking at that time. It's extremely unusual to see a flight to safety. Normally, when you're getting out of stocks, it means people go into bonds. But here we saw that treasury yields were rising. And as that was happening, there were other problems that were becoming apparent. So here is the size of dealer balance sheets in U.S. Treasuries, and you can see that they're rising, but they stopped at a certain stage. And if you look at what happened, it seems like the dealers became unable to handle the surge in demand to trade treasuries. This is a point that Darrell Duffy has emphasized in a number of venues, and I think it's quite important. And this is a chart from one of Darrell's presentations, where you can see in red the assets of the biggest banks in the United States, and in blue the size of treasuries outstanding. And one of the things that happened after the financial crisis is we started to rein in balance sheets of dealers. They were very, very highly levered in 2008 and 9. They've added a lot of capital, but their balance sheets have leveled up. And you can see these red lines now are kind of flat. Meanwhile, the treasury market has grown. And post-COVID, you can see it's forecast to grow quite a bit. So we have a situation where the pipes through which the trading happens is become fixed, and the flow through it has grown quite a bit. So the narrative that people talk about is that this market froze up and became pretty dysfunctional. Here's two indications of it. The bronze line here is the bid offer spread on treasuries, which you could see rose by almost a factor of 10. And the blue line is a measure of arbitrage that seems to have broke down. This is a particular type of trade that lots of hedge funds engage in, where they would sell treasury futures. They fund that by buying the the cheapest to delivery treasury note, and then they close the contract at maturity by delivering the note. And then you can compare the repo funding rate for that trade to the actual repo rate. You can see that normally this trade isn't very profitable. They lever it quite a bit to try to make it more profitable, but this thing exploded at the same time. Now, as this was going on, you saw it spreading out. So you could see that funding costs in dollars rose, and you could see that the central banks around the world started hungering for dollars, and the swap lines that the Fed opened up very quickly accelerated in their usage. This same problem became apparent in other markets. So here's some numbers from the UK, where you can see that the yields on gilts also were spiking around this time. And then you could see that the UK stepped in, as did the Fed. And so as this was going on, you had the Fed announcing several big QE programs and opening other facilities, the Bank of England doing the same thing. While that period was happening, this period that the Bank of England's interim financial stability report called the dash for cash, you had that perverse relationship between treasury rates and equity markets. And you could see very heavy outflows from money market funds, okay, that only turned around as QE began. So if you look, this then spread into the rest of the financial system. Here's funding costs measured as borrowing rates for corporate borrowers of investment grade. And these are spreads relative to treasury. So I already told you treasury rates were very highly elevated. The spread on top of that was elevated. This was going to infect the capacity of the real economy to function. And if you look, the treasury market problems were also apparent for the corporate bond market. You could see that the dealers actually stopped adding corporate bonds to their balance sheets. They were shrinking. That reversed once the Fed stepped in. And you could see that measures of transactions costs computed through looking at the cost of trading here for different types of trades also flew out. Okay, so what to make of all of this? I think this is one of these spirals like we saw in 2008 and 9. In this case, it seems that the proximate cause was as volatility associated with just, I think, the bad news about COVID became apparent. You saw a lot of asset prices moving around. people that had derivatives positions were forced to come up with margin calls, and margin calls require you to show up with something you can present to pay someone. So that requires almost a bank deposit or central bank reserves. That required these people to trade things like treasury securities to try to get their cash. However, as they were doing that, the treasury market stopped working, as I just explained. That made the bond prices more volatile, which meant the margin calls got bigger. The money funds were also seeing people pull out of them to try to get money, and that created this spiral that ended only when the central bank stepped in. Now, what's important here is that because this seemed to be the proximate problem was a need for reserves, that's something central banks can handle pretty well. They can just do open market operations, and that supplies reserves. So this was a case where the remedy was relatively easy, even for the Fed, which has a pretty constrained mandate. I want to close by posing the questions that I think this raises going forward. And so I'm going to put up 4 of them, and maybe we can talk about these as the Q&A evolves. So the first one is, if it's going to be the case that central banks have to step in to backstop financial markets, does that mean that there's got to be some sort of a market reform? This is now the second time really in 11 years that we've done this. And if we are going to do reforms, who should be covered? Second thing is, we have layered on a lot of regulation on the banking system. One of the big innovations has been liquidity regulation, where we've created requirements for high quality liquid assets. If it turns out that treasury securities can become illiquid and not really be the safe asset that you might have thought, how do we handle that kind of a world? And what do we do about the fact that the financial system is no longer just the dealers, but a whole range of other intermediaries? And then finally, are the money market funds regulations that were passed sufficient, or do we need to do something so that the money market funds would retain cash-like properties even in stress? So these are a lot of questions, but I think this has been a crisis that's revealed lots of things that you might have conjectured. Now we've lived through a stress, and if you're interested in seeing more about this, I pointed to some additional reading that you can undertake. I want to particularly recommend the 2 speeches by my colleagues at the Bank of England. John Cunliffe gave a very nice, comprehensive assessment of stress. And if you want a blow-by-blow on what was happening, Andrew Hauser, the director of markets, gave this very detailed account of what was going on. So if you're looking for more, these are places to start. So with that, Nicolas, I'll turn it over to you and Peter. Thank you.
Thank you so much, Anil. And let me remind our audience that the slides will be uploaded on the Peterson Institute website immediately after this session. So they will be available later on, not just on the video, of course, but also as a separate document. That's to a question from Marcus Stanley, I think. So I have tons of questions to Anil, but Peter goes first. Peter.
Thank you. Thank you for inviting me. Anil, thank you for that good presentation. I'm just going to urge us all, and I'm not going to try to teach Anil how to suck eggs. That's not my point. But for us all to try to step back and put this in a bigger context and ask, why in 2020 would important markets have impaired functioning? I think Anil's already alluded to why dealer balance sheets might not have grown as rapidly over the last 10 years as the market for treasury securities. And this isn't the consequences of an unsupervised natural selection or the laws of physics. It's a result of the choices the financial authorities and monetary authorities have made. And I think we have to recognize that. I think the episode in the US Treasury market is much more disturbing than even Neil is alluding to. I think it's a consequence of the Fed's big balance sheet and paying interest on reserves, the post-QE regime, and I think we need to see it that way. We have to be careful not to adopt literally the metaphor of liquidity as fluid dynamics in which more is always better. The Fed has flooded the system with reserves and pays interest on those. That has profoundly impaired the functioning of our interbank market from what it once was. and taken down with it the efficiency of our repo market. So the shortcut, instead of spending an hour talking about monetary mechanics, is to underscore that one of the facilities the Fed announced in late March was a special repo facility for select foreign central banks. This was not a statement of the Fed's confidence in the efficiency of our repo and treasury market. It rather was the Fed's confession of its lack of confidence in the liquidity and efficiency of our treasury market. And I think that's something that we should all worry about. And that if you suppress the functioning of markets, you will find it hard to deal with episodes of acute stress. And I think that's the core choice the authorities have to grapple with, is if we want to immunize our financial system from absorbing too great a shock, the shock will pass to asset prices and the central bank's balance sheet, full stop. That's the only place it can go. Now, let me also note that for the last 10 years, the Fed in particular and most central banks have adopted a modus operandi of targeting overall financial conditions and using the various financial conditions indices as their guide. And if they want to ease policy, they want to press these indices down. These indices almost all correlate with volatility. They weren't intended to do that, but they do. So monetary policy has spent 10 years suppressing volatility as the way they think they stimulate the economy. It doesn't have to be that way. They don't have to adopt that worldview, but they have. And it's how they've backed into only aiding Main Street by aiding Wall Street. I don't think they do that because they want to make rich people richer. I think it's a consequence of their mindset. But suppressing volatility is, without a theory of optimal volatility, is not going to make markets function better. It will make them function worse. And I think we just have to grapple with that. And let me note that I think we should see this topic under the heading of what are the limits of financial repression? And to my mind, the limit is the following. You can suppress all of the volatility some of the time, and some of the volatility all of the time, but you cannot suppress all of the volatility all of the time, or you will end up impairing the efficient functioning of important markets. And let me just end by noting that Goodhart's law must apply to financial conditions just as it does to the monetary aggregates. That if
Peter, I have to interrupt you there because I'm not sure everybody is familiar with Goodhart's law here.
All right, you can define it, or Goodhart's law says if we take a measure and we turn it into a target, we will decay the information target of the measure, the information content of the measure. And that's a good explanation of why monetarism didn't work once you start targeting the monetary aggregates. And so if you take a measure like volatility or credit spreads or the shape of the yield curve, and you turn it into a target, which the central banks have all done, the information content is not what we thought it was. It's something else. And I think the authorities have to grapple with their theory of optimal vol. And I'll just end by saying, I know that they've been targeting too low a number. Higher vol is a better way to make the financial system more resilient. And I'll stop there.
Vol is shorthand for volatility.
Yes, right? For volatility.
Sorry, I'm the acronym police and shorthand.
But I'll let me stop there.
Anil, that was a lot of criticism of the central banking community. Now you're on the financial policy committee, so you're in a way part of that community again. Do you think Peter was too harsh?
I think he restated one of the questions I had, which is if you're going to intervene to support these markets, is it reasonable to leave the markets as they are? I guess I think his critique is fair in many ways, but there are things you could do to reform market structure or reform market rules that would mean that the natures of the interventions would be somewhat different. I mean, I think we're a little bit in a no man's land where we have much of the architecture that's kind of carried over from the last 10 or 15 years, but we haven't dealt with, for instance, the fact that the dealer balance sheets are just smaller. So we've let the system continue to run as it is without doing anything very radical to it. And maybe it's time to start considering other alternatives. For instance, like Duffy's proposal, just to give an example, is he thinks treasuries ought to be centrally cleared so that we have anybody who wants to trade us a treasury can do that without having to pass through a dealer balance sheet. So that would be a radical suggestion that would perhaps cure some of this. I'm not trying to argue that Peter's meta theorem of you can't suppress all of the volatility all the time is wrong. I agree with that. But there are intermediate solutions that you could look at as well.
And if I could just say, I should have said, I think Daryl's paper is terrific, and I think we should always be trying to improve the plumbing and the infrastructure. But it's really just a question then of tidy velocity. That is netting and clearing arrangements, which go back to in monetary policy and monetary history to the fairs of medieval Europe, where the merchants learned how to net payments among each other. So it's a fine way to improve efficiency and tidiness. I don't think it'll address this problem of what's optimal volatility. And the authorities, I think, have to confront that.
So I have a first question from Caroline Atkinson, who was one of our speakers in the previous session. The question is, does Peter's analysis effectively describe the limits of monetary policy? In other words, we need monetary authorities to step back and fiscal authorities to step up. Would you say this squares with your analysis, Peter?
Yeah, I think it's yes, I agree. It's a way to start thinking about the limits of monetary policy. There are only so many intertemporal trade-offs we can encourage, and I would maybe say it slightly differently. Liquidity of a market is a behavior, not a quantity. It's not a quantity of a thing. It's the behavior, the willingness of others to buy what you want to sell or sell what you want to buy, or lend what you want to borrow and borrow what you want to lend. And I think the Fed and some central banks, but the Fed in particular, has adopted the quantity theory of market liquidity and ignored the behavioral definition of market liquidity. And I think that's the piece with where is the limit of what we can do with intertemporal trade-offs.
Anil, do you agree with this way of describing things? It's a pretty big...
I certainly agree with his definition of liquidity, which is, who's willing to trade when, under what circumstances. And I think, it surprised me to see the off the run and on the run treasuries dislocate the way that they did. And that to me is a bit of a canary in the coal mine. The one way to think about it is, if the treasury market gets unhinged and those prices are no longer reflecting just discounted cash flows with a stable discount rate, but instead are depending on all kinds of these vagaries, then that price kind of creeps in to every other price in the market. So the way I think about it is a necessary condition for the stability of the financial system is that the sovereign yield markets are working reasonably well, at least the ones where there's no credit risk. I don't want to say, some of the stuff that happened in Europe where you're really thinking about governments defaulting need to be protected, but there's no credit risk to U.S. Treasuries. So U.S. Treasuries ought to be anchored and traded freely with minimal frictions, and normally it's the deepest market in the world and works well. That has to be true for financial stability to be satisfied. There, you can get lots of other problems, and usually I spend my time worrying about other markets becoming unhinged, and you have a flight to safety where the treasury yields are collapsing. So the fact that that the core ran into so much trouble should be something we worry about. That's kind of the way I think of it.
If I could just add to press down on the micro of the repo market, how it supports our treasury market.
Yep.
In my mind, and I may be wrong, but the way I've always thought about it, by definition, the marginal buyer of a treasury security is doing it on leverage. Because if the leverage isn't there, he's not there to be the marginal buyer. Now, that's a simplifying assumption. And the repo market has been the source of the marginal leverage for the marginal buyer, the treasury securities. So they can arbitrage and keep those prices where Anil thinks they ought to be. To my way of thinking, by flooding the system with reserves and maintaining the big post-QE balance sheet, the Fed has not unclogged the pipes, it has clogged the pipes between market participants. Because by leaving massive balances in the system, it diminishes the incentive for any one bank to worry about whether they're long or short reserves on any day and whether they should lend those in the repo market or not. So it suppresses the network of pipes that is the market and reduces all the participants into a bilateral relationship with the central bank. And thus we should be unsurprised when the system as a whole has to jump and get more of that from the central bank.
But Peter, if they had ditched the funds rate and said, we're just going to have a repo rate as our target, come and get it, you can have as much as you want. We're going to have a huge number of treasuries on our balance sheet and a huge amount of reserves, and we'll move in either direction the way you want. Would you be happier with that?
Well, yes, I would have been happier with that in the crisis, in the event of March. And I would have been much happier with a corridor and the Fed acknowledging that the basic choice of the big post-QE balance sheet or shrinking it was a choice between allowing price signals to allocate reserves within the banking system and supporting our treasury market, and not having price signals allocate reserves within the banking system and supporting our treasury market. And they chose the latter. And so a corridor, as sloppy as it might have been in the post-QE regime, and using repo facilities to give people what they need, would have been a better way. In another technical thought about Anil's slides, Anil points to the bid-ask spreads. And I think it's telling that the Fed did not intervene in March as a dealer on both sides of the market, either in treasury market or in the high yield and investment grade market. They chose to become an outright purchaser. More sensibly, to try to intervene if market functioning breaks down would have been to enter as a dealer without the intention, a market maker, without the intention of maintaining an inventory, but simply to guide bid-ask spreads until they're tighter. That is, in fact, what the New York Fed did after Ronald Reagan was shot in a single-day episode when the foreign exchange markets were impaired. It entered the market to make markets on both sides. And the Fed could have done that in the US Treasury market. It could have done that in investment grade and high yield. And we would not have ended up with in the position of the central bank now engorging its balance sheet yet again, taking on more assets as a permanent fixture.
Right. So I have to apologize to some of our attendees because this is slightly technical. We are talking a lot about market structure. We're using some jargon, not too much, but some. But I think it's inherent in the nature of our subject matter. So this is maybe a slightly more technical session than the previous ones, but I think that was inevitable from my choice of topic, for which I'm entirely to blame. We have a follow-up question from Loriana Pellizzon at Frankfurt University, I think. But the target repo rate is a security lending facility, right? Is that right? Or if I got it wrong, it's my mistake. I think you're mute,
Peter.
Yeah, well, that's not the way the Fed is operating. The Fed has adopted a regime in which the interest on excess reserves defines the floor here in the United States. And that has effectively become their target rate, even though they don't say it. The repo rate is not something the Fed has been drawing attention to as having significance in its current regime. Anil, did I mistake that, do you think?
I agree.
So let's talk about regulation for a moment. We have a question, for example, from Mark Siegel. Are we not talking about regulatory objectives that clash directly? Smaller is safer as a proxy for safer banks, dealers' balance sheets, versus the need for balance sheet capacity to be sized properly to absorb market risk under stress scenarios. So if you think of the Basel package of capital ratios, leverage, liquidity, so Mark is adding, maybe you can have it both ways. What is there anything to ask the question in very simple terms, maybe first Anil and then Peter, do you think this episode per se should lead to a revision of the Basel package? And if so, what revision would you recommend?
Well, for a long time, I've said we ought to have a Basel committee on shadow banking to go with the one that's on banking. So, but I think part of the problem was we had the infrastructure to easily reform the problems we saw in the banking markets in 2007, 8, 9. And so we acted. But then kind of a conservation of risk concept creeps in, and we saw risk spread out to other places. And so a lot of things that used to be done in the banking system or on the dealers' balance sheets now have migrated out. And I think that's part of the problem. I don't think the idea that more capital was needed for the banks deserves any rethinking. I mean, some people are going to say maybe they need even more. What happens if it turns out when we get a second wave, if all these businesses that are right now illiquid become insolvent? Well, you're going to have a banking set of problems in that case. And then you're going to look back and say, well, wow, we were pretty complacent about the levels of capital. So I don't think the idea that capital was too high deserves much consideration. But whether or not we pushed things out of the banking system and then didn't follow them is something I worry about a lot. And in most countries, it's easy to get into the cracks between the banks and everything else. One of the problems in the United States is many of the other regulators, aside from the Fed, don't even have a systemic risk perspective. They don't think of protecting the financial system. They think of, well, I've got this one narrow job that I'm supposed to do. And if somebody calls attention to the fact that there's this brewing problem, but it's not right on their mandate, they're inclined to say, well, that's not our job. I think that's been the big lapse post-Basel.
So let me follow up on this. First, on non-banks. So we have a question by Thomas Dorn. Was the shadow banking sector a decisive driver for the dash for cash, money market funds, mutual funds, hedge funds? I think you answered yes. If so, should new regulation focus on these entities? So my question, elaborating on Thomas's, is what kind of regulation? Do you think of capital requirements for those market participants? Do you think of something different, just enhanced supervision, or something quantitative in terms of ratios or stress testing? What would you have in mind?
Well, it's easiest for the money fund, so let me take the low-hanging fruit. What a money fund is very much like a bank, right? They say they take no credit risk, but in fact, we know they take liquidity risk, and yet they hold no capital. So the money fund structure is, I think, pretty inherently unstable because we treat these assets like they can be converted upon demand into something that's redeemable at par when we know that lots of their assets aren't. So I think that's an area that there's a pretty simple fix for. We've got to do something. We can't just leave it. This is just my view. I'm not
speaking. So would the fix be capital requirements or liquidity?
I think you could tighten down. So government money funds didn't have problems, but these prime funds that hold things like commercial paper issued by highly rated companies, but whose commercial paper doesn't trade, is treated as if it's safe and can be redeemed at par, when in fact it can't. That's kind of a lie. So I think, prime money funds are an area where it's pretty easy to see what the problem is.
I'm pushing you. You identified the problem, but not the solution. What kind of ratio would
I'd be happy to see them have to hold some capital, or specify that their sponsors have to step in or something. But we're in a situation where we pretend that there's no risk, and then in some countries you ban the companies that set them up from providing support, where they might even be willing to provide support. But I think that's a structure. It was involved. It was maybe not the central problem, but it's one where it's kind of clear what to fix. If you're looking at entities, let's say pension funds, insurance companies that might have been trading and needed to make margin calls and were scrambling to get the cash, I don't know that you need to regulate them directly with something like capital, but you need to start thinking systematically about the entire system and ask yourself, where is the money going to go? And one last point I'll make is a lot of the money that's in money funds are parked by companies that want to put their money somewhere. And this is a hard problem. The banks may not want to have huge deposits that could run in and out. The money funds are willing to take them. They offer a little bit more interest. If you did the action I said, which is to clamp down on the prime money funds, that money's not going to go away. It's going to go somewhere else. And so you need to think about where it's going to go and what you're going to do about when it does move. And if the answer is, well, it just has to go into the banking system and earns less of a return and involves less functionality, but that makes the system more stable, then so be it. But we ought to be honest about it. We can't pretend there's a free lunch here.
Peter, on this issue of money funds, we'll go back to banking regulation later, but on regulation of money funds, any views?
Well, I agree with what Anil said. 10 years ago in the acute crisis, I remember the epiphany of realizing a money fund is an entity with infinite leverage. That's the better way to think about it. And so whether it's capital or liquidity, I don't think it's important. We need to do something, as Anil was saying. You can imagine using capital regs, you can imagine using liquidity regs. Something needs to be done there. Just a second observation of three. 10 years ago, my recollection is that big corporate customers with those treasurers ended up dividing their cash between money funds, treasury bills, and bank deposits. And they really didn't give a damn what the yield was. They just wanted to have three different sources. They didn't want to manage too big a book of treasury bills themselves. They didn't want to put too much in the money funds. They didn't want to put too much on the books of the banks. And I think you've got to get to solve Anil's thought, which is a good one. How's the system going to work, the money fund system? I think you've got to think from the customer perspective as well. I do want to go back to my bigger context, which is we've constrained the regulated financial system for 10 years and not had its balance sheet grow. And yet monetary policy in the United States pursued a policy of seeking to expand non-financial commercial credit. And it's grown as a share of GDP for 10 years. That's how they thought they were stimulating the economy. So you're not going to grow the financial intermediaries' balance sheets, but you are going to grow the quantum of credit that non-financial corporates incur. It's going to go somewhere.
But isn't it, in a way, less dangerous to have it in non-banks than in banks? I mean, how do you see it as a trade-off? If it has to go somewhere, isn't there, by and large, a better, discipline in the non-bank sectors? There's more capacity to absorb losses in terms of the ultimate owners of the securities. I mean, what do you think of that kind of reasoning, that banks are uniquely risky in a way, and that having them downsized as a share of the total credit system might be a good thing?
Yeah, in principle, subject to Anil's analysis of the money funds, you have to have something, liquidity or capital. So you can't just say it's going to be better at absorbing. You have to make sure it has some capacity to absorb. I would add, I think this generation of central bankers, forgive me, is very squeamish about market volatility. They can't imagine a volatile Fed funds rate. Alan Greenspan didn't give a damn whether the Fed funds rate closed 10 or 20% higher than it was supposed to, as long as I managed it to a 2-week average. There was all sorts of volatility that took place in the interbank market, and it sorted itself out, and that was a way the system worked. And I think the same is true. So it's not just that my little observation, they're targeting too low a vol. I think we can see in their behavior, they're squeamish about prices moving around.
Anil, you already answered that one, but I ask it again. Do you share that view?
I don't know. I'm not inside their heads, but I think this question of whether or not there's the elephant in the room is there a central bank put on the entire financial system has a central bank put is something that the central banks need to reckon with. They can't pretend that this isn't something that market people are talking about, and the cost of intervening in such a strong way is something that's going to shape expectations going forward. I think there is a a line in the sand you can draw that follows from the observation I made about the necessary versus sufficient condition for financial stability. I think it's classic central banking to say that if the treasury market, for whatever reason, has become unhinged and prices are dislocated and you've got on the run, off the run treasuries trading at very, very different prices, going in, with massive force to restore that order doesn't strike me as exotic or creating a huge amount of moral hazard. I think that's probably okay. I take Peter's point that it might be the case that there are market structure issues and other decisions that you've made have contributed to that problem, but at least just cleaning that up, I think, is a pretty safe operation that's well inside the boundary, and I don't think there's a lot of moral hazard associated with that. It's once you start doing things that change other asset prices and you deem some of these markets systemic or implicitly systemic, and then you can't quite understand why this market was rescued and that one wasn't, and what's the reaction function the next time. That's where all the hard decisions are going to have to be made.
So let me shift to a slightly different issue, which is bank regulation. And for example, let's start with liquidity regulation, and then we'll come to leverage. There's a question by Tim Clausen: what was the role of bank liquidity regulation in leaving the dealer capacity to the Fed? And I would expand on that by asking if, and Anil, I know this is something that you have worked a lot on, did we see any perverse effects of the liquidity regulation that was introduced after 2010, or would you say it's kind of fine in terms of bank liquidity again? There's no need to change something that works reasonably well. Anil first.
Well, I'm curious as to what Peter's view is on the so-called supplementary leverage ratio. So one of the things that...
We'll come to the leverage ratio later. I'd like to focus on liquidity first.
Okay, so I think on the dealer balance sheets, it's the implicit limits on repo that are probably highlighted by some of this, and I don't think the liquidity regulation is at the core of that, but there were post-crisis reforms that have made it more expensive for the dealers to do repo and to grow their balance sheets, and I think that's something that some people have been pointing to. I don't know that we've got the kind of case study to see exactly which banks step back when, which I'm sure we'll get in 6 months. There'll be really granular, bank by bank, hour by hour analyses of where the trouble was coming from that you can then try to go understand what the constraints were. But I'm not expecting the liquidity regulations to be the ones that are at risk or at fault here.
So let's move on to leverage ratio, unless Peter wants to jump in on liquidity. Peter? No. So leverage ratio, after the episode in March, the Fed did change their rules for leverage ratio. There were also some changes less far-reaching in the European Union with the so-called CRR quick fix package. And I understand that this was in response to the March episode, maybe also to the repo episode in September last year. So is it wise? I mean, my own reaction, and I'm on record on that, so I can mention it, was to say, well, it may be a bit dangerous for the Fed to exclude sovereign exposures, treasuries holdings from the leverage ratio. It's a bad example for other jurisdictions, if nothing else. And thanks God the EU has not emulated that in their CRR quick fix. But I'd like to have your views on this leverage ratio tweaking and where to go going forward. Is the leverage ratio a problem? Is it just fine to say reserves at the central bank should not be included? How to think about it all? Anil.
So the way I think about this is there's some things that you want your dealers or that you want intermediaries to do that really are essentially riskless, and you don't want to tax that. So if they're holding reserves, that means that their balance sheet is larger, and if they actually have to hold capital against that when you think that there's really zero risk to do with reserves, that there's a reasonable case for carving that out, I think. And
but just interrupting you on this, you would carve it out permanently, because currently the Basel Committee says only on a temporary basis. Do you
yeah,
think
and I don't want to get into that debate. Let's just keep this conceptual. That there are some things that are riskless that if you regulate it and tax it, you're going to get less of it. So I was going to use the example of this matchbook repo, where you do a repo on both sides, and you basically are just standing in between to try to make a market. You're not taking on any risk if it's literally you're selling one thing and buying exactly the same thing, and that you're not trying to arbitrage, you're not trying to do anything, you're just trying to intermediate. In that kind of a circumstance, if you're gonna say that if you do that, we're going to treat you as if you've grown your balance sheet and become riskier, you're going to get less of it and you're going to get more volatility. And I think you can make a case for something like that being excluded permanently. So it goes back to the point Peter was making, which is kind of which types of volatility do you want to tolerate, and which types of trading do you want to encourage and discourage. I think market making is something that takes an investment. You've got to have infrastructure, you've got to have people, it's expensive. If you want to make it more expensive in the name of safety, you can do that. That's going to reduce the amount of it, and it's going to push things outside. And I'm more worried about the push outside actually than most, because it just seems like that always, everybody nods their head when you talk about that, and then you come back a year later and it hasn't changed much. And that's because it's hard and there's no easy fix.
Peter?
Well, I think what Neil said is entirely sensible, and at the risk of going too far, Nicolas, into the micro of this market, we got to be tweaking the supplemental ratios and thinking hard about how the system actually works. And to elaborate on the simple point I was trying to make earlier about the quantity of reserves the Fed has created, discouraging an efficient market. One of the things I learned long ago in the Fed funds market, which was a lovely little microcosm to learn as a younger man, is that if a bank trader, Fed funds trader, went home early before the Fed wire closed, the reserves that accumulated in that bank's account were as good as sterilized, right? So if the distribution of reserves is churning in the banking system, and someday it all ends up in the account of Citibank, but that day, Citibank's Fed funds trader has gone home early for his 6-year-old daughter's birthday. Those reserves are as good as sterilized. They don't exist for the rest of the market. And what the Fed's big balance sheet has done is make every bank behave that way most days. There's such a plethora of reserves, they have no incentive to care about trading them out, and they've stopped hiring Fed funds traders and stopped having people care. And that means there's a less efficient market. So whether it's 5 billion or 500 billion or $1 trillion that's accumulating in these accounts, if there's no one there to trade it away, it's as good as sterilized. It's dead to the rest of the system. And the Fed's answer to that is to pump more in, which on any one day suppresses volatility, but also suppresses the market behavior of finding people willing to lend what you want to borrow and borrow what you want to lend in the future. So forgive me, that's all inside your question about the supplemental reserve ratio, liquidity ratio, and how we think about it. So if we say, oh yes, let's count reserves, but we know we have a banking system where no one trades them actively and they're not there for anyone, they're just there for the individual bank, I think we've made a mistake in how we think about the stability of the system by only focusing on the balance sheet of the one institution.
Anil, a follow-up question from Steve Cecchetti. When you mentioned the matched book repo, Steve says there's counterparty credit risk, but that's a different kind of risk, right?
Yeah, and sure, but I still think if it's true, there's a tiny amount of counterparty risk. People do tend to step back when they think the counterparties are risky. I mean, if you look at Lehman, its last days, or not Lehman, Bear Stearns on the day before it was rescued, it couldn't repo its treasury. So I don't think the counterparty risk is so big because they just won't do it. But I mean, the general point is just how much do you want to tax the market making, and what the consequences are. And I think Peter's got a good point of some stuff just disappearing and people ceasing to invest.
So I have another, to go back to your point, Anil, about the elephant in the room. So another question from Caroline Atkinson, which is actually to Peter. Can the Fed get out of the current bigger context of the put without triggering a crisis and or hurting the real economy? Peter?
It would be very hard. That's a great question. But that's why I think the thought experiment about what the Fed might have done in March other than what it did, and my suggestion that what about just being on both sides of the market regardless of price level? So stop trying to fix prices, try to ameliorate widening bid-ask spreads. And that would be the way a central bank might begin to walk back from always just growing its balance sheet and becoming an asset accumulator to one who's trying to focus on market functioning. But obviously, it's a long way to go once you've got your balance sheet this big to try to get it back to something that helps markets be nimble as well as the Fed. But so there are a number of steps the Fed could take to walk back from the put. I think the intervention, outright intervention in investment grade and high yield will look bad 10 or 20 years from now. I don't know why they thought they had to accumulate a position in corporate credit in order to help stabilize market functioning. It's like they took a page out of the Bank of Japan's playbook from a dozen years ago. They're going to try to compress credit spreads. That's pretty, esoteric stuff trying to address the crisis in March. So there are things the Fed should start to do less of and be subtler in its intervention in markets to make them work better, is how I would approach that difficult question Caroline asked.
Peter, can I follow up on that? So would you have a bright line that just goes to the distinction I was making a little bit ago, which says if the treasury market is messed up, we're going to take steps, whether it's the one you just suggested or buying, and we're going to defend that and make sure that that's always working. And then everything else, buyer beware. No other market dislocation is so critical that the central bank should be there.
Yeah, yes, I think that would be a good sort of conceptual place to start. It's a good thought experiment. Go back to March. Imagine, and you have to imagine they adopt suitable words for this, but the Fed simply announces, we will monetize every dollar incremental borrowing of the United States government to respond to COVID. But that's all we're going to do. That's a pretty big thing. And we're going to make sure the treasury market keeps functioning well. And they stop there. They don't do a lot of other stuff. They just focus on the base asset in our monetary regime, US Treasury securities, its close substitute in Federal Reserve liabilities. There you have it. That's what we're going to do. And yeah, that would be a way to walk back from the open-ended put or the perpetual intervention in asset markets.
There's a question which kind of ties with this, which was asked also by Steve Cecchetti. Anil points to the stress in mid-March, notes that central banks can supply reserves to stabilize the markets in the face of margin calls. That this seems to justify, in Steve's words, the Fed's purchase of about $800 billion worth of treasuries in the second half of March. Markets seem to calm down very quickly. The intervention was successful. But still, Steve talking, the Fed kept buying, so that April 1, they have purchased another $900 billion. How can we understand this further purchase? Question to both.
I guess I'm not sure. It's easier to see now that the markets calmed down. I think their policy response in the beginning was, we're just going to throw everything at it. We're going to open the swap lines. We're going to open these new facilities. We're not sure in real time that this dash for cash is really limited to just this very narrow problem. It now, and it's hard to know the counterfactual, which is if they had not done all these other things. I mean, one thing that's remarkable is merely announcing the secondary market credit facility was enough to move the spreads off even before they had to buy. So there were some things where they, put a backstop in. They didn't have to pay it off yet. Open question, will they have to pay it off in the future at some point? Don't know. But I think trying to do the counterfactual where we say, we know this part was done and then this followed, but, parsing out the incremental contribution of all the package is very, very difficult.
Peter?
I don't know, I think Anil summarized that well.
So we're getting close to the end of our session, but there are still tons of questions. I'll end with two questions. One is by Marcus Stanley again. So here's how he worded it. Not quite sure how to formulate this question, but is there a need to rethink the public-private boundary more systematically instead of just rethinking private market regulation? Can we create permanent public utilities for risk-free money which create more short-term money market stability while leaving relative price signals for longer-term asset markets informative? And there was also, I think in kind of the same logic, a question by Sylvain Boyer from S&P, which was, would a bad bank be a better suited balance sheet to absorb the losses rather than central banks' balance sheets? So, let's have the two of you on this. It's a broad question.
Okay, so say a couple of things. I mean, one way to rephrase this that it's easier for me to answer is, if you look back at Dodd-Frank, it said we didn't like 13.3, we didn't like the central banks going off.
And 13.3 is.
We didn't like the idea that the Fed could declare an emergency and say we're going to begin buying or lending against assets of all types. And so we restricted the Fed's ability to do that. The turning point, in my view, in the 2009 episode was the stress tests on the banks to reassure everybody that the banks were actually okay. When that stress test was done, it was done in the shadow of the money from the Troubled Asset Relief Program, the TARP money that was sitting there. And one part of the TARP was earmarked to say, if it turns out that bank equity turns out to be a troubled asset and the banks are in need of a rescue, if they can't raise the money privately, we will step in and use TARP money to backstop. And then the banks went out and raised private money and blah, blah, blah. Now, fast forward to this episode, Congress and the Treasury had figured out, you know what, if we put some loss absorbing money in to the CARES Act, this $454 billion that was given to the Treasury, we can then set up essentially a special purpose vehicle where they buy assets. If there are losses, the Treasury money would be the loss and the Fed would lend into it. I think one way to rephrase that question is, suppose instead you tried to do a private public partnership. You would have taken a little bit of that CARES money and you would have said, here's some money that will co-invest with the private sector, and let the private sector pick where the purchases should go. We do something where the terms would be pretty favorable for the private sector. The Treasury wouldn't take all the losses and so on. I think you could imagine that world as an alternative to the one we went into. It would have been messier. You'd have to do a lot of planning ahead to stand up such vehicles. But I certainly have talked to people in the private sector that weekend right before the Fed came in, people were raising money to go into the markets. I know one large firm that wanted to arbitrage that Treasury basis trade that I showed. They, according to a person I spoke to, raised $2 billion to try to close that gap. The Fed came in, it went away, so they returned the money. So I think you could imagine the private sector playing a much bigger role in all of this, but it won't happen organically, quickly. It'll require a conscious decision. They're going to have an honest conversation with Congress, because somebody's going to get rich on the back of this. But you know, that's the way markets usually work, is people take risks, they get rewards. And
Have
so as
you-
long as the Treasury isn't taking all the downside and none of the upside, I think you could imagine something like that.
Have you written about this public-private partnership concept? It sounds
No, just, you know, over beers.
yeah, well, I will certainly read your piece whenever you write it. Peter, on this?
Well, I think Anil summarized some thoughts well. I would just add that we already have a public-private partnership we don't like much, which runs right through the heart of our regulated banks. We know their deposit-taking function is a public utility function, and then we let them profit maximize on the rest of their operations. And so the whole financial system is littered with good and badly designed public-private partnerships. And I think sorting it out is the challenge that lies ahead, and Anil's pointed it out. I think a necessary precondition for it, in my view, Anil doesn't have to subscribe, is central bankers have to have a little more stomach for market volatility. I recall 1994 and the bond market turmoil as how the financial system helped absorb a shock for the real economy, and we got a soft landing in the US real economy in 1995. Many central bankers took the opposite lesson. We can never let that kind of volatility happen again. That was bad. Don't let it happen in government securities markets. That wasn't what I took away from 1994. So I'll stop there.
Right, and we'll have to stop it anyway because we're out of time. There are many questions we haven't started to tackle, starting with the international aspects of all this. We had questions from Ted Truman, from Prakash Lungani at the IMF, obviously issues in the UK around government financing and issues in emerging markets, but that will be for another conversation. Meanwhile, very many thanks to Anil, Kashyap, and Peter Fisher for having accepted to participate in this conversation in our financial statement series at the Peterson Institute. We'll have the next one in 2 weeks' time. It's actually already on the website. It will be about the Chinese banking system with Chen Jun, who is a very good specialist of that in Fudan University in Shanghai. And as the second speaker, our own Nick Lardy of the Peterson Institute. So I hope that we'll have very engaging conversations on this as well. And have a great rest of your day. Thanks again for participating in this discussion.